Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. Canada is working on a comprehensive deal with India to boost trade and investment. This comes as Indian Commerce and Industry Minister Piyush Goyal is in the midst of a three-day visit. Goyal met with Prime Minister Mark Carney in an effort to strengthen bilateral ties. Carney says a deal with India would be a game changer for Canadian businesses and workers. The two sides say they hope to conclude a deal by the end of the year. The combined federal and provincial debt is expected to reach $2.4 trillion, according to the Fraser Institute. Debt has grown substantially since the 2008 financial crisis. The study also shows the combined government debt now equals about 75% of the Canadian economy. Manitoba has the highest combined debt share of the economy, while Alberta's provincial debt remains the lowest. Bank of Canada External Deputy Governor Nicholas Vincent says Canada needs to rethink its approach to education and training. Speaking in Montreal, Vincent cites the challenges young people are facing in the labor market, noting that they are overrepresented in the unemployment category. He pointed to structural factors, including an influx of young immigrants, a mismatch of skills, and the growth of AI as possible reasons. And taking a quick look at the markets right now, and the TSX having an off day after that surge yesterday. Every indice, all the indices are in the red right now, dragging everybody down. Consumer staples, healthcare, the worst off. And south of the border, different story, although the Dow Jones taking a turn there, but the S&P 500 up by 0.71, hovering around record territory. Same with the NASDAQ, it is up 1.18. As we just said, the S&P and NASDAQ are climbing this morning on hopes the U.S. is close to an agreement with Iran. Our next guest argues that geopolitical tensions, surging AI investment, and labor market strains are pushing markets up a classic wall of worry. Still, he's optimistic that the AI boom could fuel economic growth, much like the steam engine or the mobile phone did in earlier eras. Joining us now is Michael Monahan, founder of Founder ETFs. And Michael, thank you very much for joining us.
Thanks for having us. Great to be here.
That's quite a comparison, AI to steam engine and cell phones. Where does that optimism come from?
Well, if you look at a lot of these big technological cycles as they've come, and we can look at the steam engine or electricity or the internet, or the one that's most near on investors' minds is the cycle that the iPhone brought. Remember, when the iPhone came out, it collapsed 30 categories from the calculator to the alarm clock. However, it created entire new industries, whether that be ride sharing, food delivery apps, or mobile payments. And so we're very optimistic that it's not a race of humans against AI. It's a race of humans using AI against humans not using AI. And we think that this is going to cause, certainly there will be places where jobs get taken out, but overall it's going to be an increase in abundance, and there'll be new bottlenecks created by AI that will require humans to solve.
And where do you see the jobs disappearing? Where do you see the creativity coming in and jobs being created?
So, certainly jobs that were, lower on the value creation scale, pushing emails around, making PowerPoints, those types of things are all being automated away. But, software development still requires great humans to oversee the automated code that's being written. Certainly anything in the physical world, whether it be stringing cable in a data center, plumbing, all of those continue to be bottlenecks that will require job creation.
And with the war in Iran, how could that derail any of this, or do you feel it won't, even if it continues where we're at right now with the strait being blockaded?
Yeah, geopolitical risk continues to be the biggest unknown. It's not just the inflation and the energy prices, but it's also supply chain impacts. Remember, I think about 30% of helium that's required for making semiconductors comes out of the Middle East. So we need stability there to keep this economy moving and growing on a global basis. It looks like we're going to get peace in the Middle East. It's grinding slower probably than anyone wants, but the tea leaves sort of read that it's in everyone's best interest to get to a good negotiated solution.
All right, and within AI, a couple of names, you're like an Oracle's the first one. Where do you see the strengths of Oracle?
We believe that Oracle is playing in the boring but highly profitable infrastructure side of AI. And I think that's what we're starting to see on multiple read-throughs is it's, Jensen's making GPUs as quickly as he can, but in order to turn those GPUs into token factories, we have to get land sited, we have to get the box built, we have to get them lit and energy put in, and then we can generate the tokens.
And Oracle,
and for that reason, Oracle's focused on that infrastructure side of the business, so we think they're very well positioned.
I was just looking at some of your notes here. Their backlog has quadrupled to over $500 billion.
Yeah, I mean, the backlog is, an order of magnitude more than their sales. So it's really strong backlog. And if we're looking at, sort of stock price performance, people got excited about the build out. And then they got a bit concerned. I think there's some spook on the OpenAI growth numbers. But what we're seeing is, if anything, we've got a little bit of a Starbucks situation where OpenAI has Google biting at their heels on kind of the low-cost solution with Gemini being embedded into search for free. And then Claude is absolutely dominating from Anthropic on the high end. And what we're seeing is that if one frontier model provider doesn't want to take capacity, another one will step up. I mean, I think the greatest example of this was, Elon just wasn't using all of Colossus One and instantly leased it for $1.25 billion a month or $15 billion a year to Anthropic. And Oracle saw the same thing. There was a data center, I believe, that OpenAI passed on, and Meta snapped it up within hours or days. So there's such a bottleneck in infrastructure right now. I think Larry sort of, he's had 40 years of seeing around corners. I think he saw around that corner a couple of years ago and really positioned himself well.
And with Ellison, I mean, I think he's 81 or 82. Any concerns age could be a factor, and succession planning?
So, Larry doesn't seem to be slowing down at all. He's 30 years older than I am and looks about the same age as me. So he's taking care of himself and he's executing. And from a succession plan perspective, he's built a huge team around him, as you know. But, as far as our fund, our mandate is we only own founders. So if Larry were to ever step down from being the leader of the company, we would have to exit the stock. But we think Larry's probably got another half a decade or decade left in him. And we're really excited about the prospects for Oracle.
All right. Another one you're liking, Palantir.
So the numbers at Palantir are just eye-popping, right? So Rule of 40, which is combining revenue growth and margins, 40 is considered highly investable in venture. That's what Sequoia and Andreessen Horowitz would jump all over. Palantir put up 127 Rule of 40 in Q4. They delivered 145 in this most recent quarter. We think there's a lot of upside there. We think we and our investors are going to get paid on that upside. We think it may take a quarter or two. Remember that Alex Karp has an absolutely dedicated and loyal retail shareholder base. We think the shiny object that retail shareholder base is now chasing, the Microns and the SanDisks and the semiconductor ecosystem. So we think it's going to take a quarter or two for the traditional growth institutional investor to come into Palantir. That's the opportunity for us and our investors, but we see that coming over the next couple of quarters.
All right, Michael, we have to wrap it up there, but thank you as always for joining us.
Thanks for having us. Great to talk to you.
Michael Monahan, founder of Founder ETFs. Up next, markets are reacting to easing geopolitical tensions. Stocks higher, yields lower. More after the break. U.S. stocks opened higher on hopes of a Mideast peace deal and the reopening of the Strait of Hormuz. Meanwhile, The yield on the 10-year U.S. Treasury, the key benchmark for U.S. government borrowing, fell more than 6 basis points. We got perspective from Earl Davis, head of fixed income and money markets at BMO Global Asset Management.
If you look at U.S. 10-year yields, they sold off basically 30 basis points in almost a 1-week time frame up to last week. But at that point, we started buying and we thought they were overdone, oversold. When you look at the last 2 years, we're at the higher end of the range. So we think it's a good opportunity now to extend duration because there could be a resolution here in Iran, and that will further reduce treasuries because then eases come back on the plate from the U.S. Because if you take out the inflationary aspect of the Iran war, then you could see Kevin Warsh really pushing for eases. So I think that comes back on the plate, and that's a reason why to own treasuries here.
What if there isn't a resolution to this war anytime soon? Because we keep hearing talks of peace deals. Obviously, that continues to not be the case in the long run. So what if this conflict continues for another couple of months?
We think if the conflict continues for another couple of months, it still makes sense to own treasuries here. We don't think inflation, even though it will be in CPI and stuff, will make the headlines until September. The reason why we don't think that is all the central banks will push back on this, push back on inflation now, basically saying it's transitory without saying that, resting their laurels on a possible deal. So we believe the Fed will have an easing bias. They haven't taken off their easing bias. So we believe that we'll push through until the fall with that. And then at that point, then you have to say inflation is persistent. If we still see it in September, October, then that changes the argument.
Okay, so it sounds like despite that impact from the war in Iran, you remain positive for growth in the U.S. in general.
Yeah, very positive for growth in the U.S. And it almost becomes a self-fulfilling prophecy in the sense that in April and May, the rally that we've seen in S&P is the equivalent of 10 to 15 trillion of new wealth. That wealth effect will keep markets buoyed. It makes people feel good about growth and spending. So we think the wealth effect will be very supportive of the market. Add in that there's still a lot of fiscal spending here. So the wealth effect impacts the private sector and the fiscal spending is the public. So when you have both engines basically roaring, I would say, it's very supportive of growth going forward.
What about for Canada's economy for the rest of 2026? Are you feeling as optimistic on that front?
Feeling optimistic, but not as optimistic. And the reason why is still 70% of our trades done with the U.S. So our very constructive outlook for U.S. growth is positive for Canada. We believe a lot of things that are but we have a lot of uncertainty here in Canada now. First, it was CUSMA, and now it's Alberta. So as long as Alberta and that referendum in September is on the plate, that adds uncertainty in Canada. It delays foreign investment here because they want to see the impact of that. So we think for at least the summer, it'll still be good because of the U.S., but less so than the U.S.
Yeah, it's interesting to see how the talk of separation there might really factor into things moving forward. I wonder then, is now a good time to have more investment in credit, such as corporate bonds?
So there's two sides. So let me answer that. Yes, we are overweight credit. Having said that, valuations are very high, so there's very little margin for error. So we feel positive because of our outlook on growth. The positive outlook on growth means default rates in companies don't jump up, don't gap higher. That's why we like owning credit. Also, given that treasuries are at the higher end of the yield, you add on the credit spread to that. So although credit spread and the valuation of spreads are very high, the all-in investment yield is nice and attractive on the higher range of things. So there's a lot of reasons to be supportive of credit, but valuations are high. So we're long and overweight, and we maintain that position.
On the flip side, then, is there anything you're trying to stay away from right now, or you think investors should be staying away from when you factor in certain uncertainties, as you mentioned? You've got the conflict in the Middle East, you've got the referendum in Alberta. Where are you not going right now?
Right now, we're going everywhere. So the thing when you get really cautious, you want to stay away from high yield because that has the biggest risk. It's the lowest credit rating, the most debt. But our outlook on growth is supportive of that. Having said that, I go back to my statement where valuations are very high. We think they're justified given the present scenario, But if they get higher, which we expect risk assets to continue rally, especially if there's a deal. We will slowly be reducing our exposure there, not because we're worried about the market, but we think we'll have the one key factor that we know is going to stay here is volatility. So we'll reduce our exposure so we can buy back at better levels.
Okay, so both the Fed, the Bank of Canada announcing rate decisions on June 10th. Are you expecting an easing or a rate hike or for things to stay the same right now at this period in 2026?
So we expect things to stay the same, especially over the summer. Having said that, the market is discounting hikes, both in Canada and US, more in Canada, surprisingly, than the US, but discounting hikes. We don't believe in hikes in 2026. We believe that we will stay the same, unchanged for the balance of the year.
Unchanged for the balance of the year. I'm going to ask you for a prediction then for early 2027. What do you think about? Because I have heard some analysts saying they believe that we could see rate hikes by then. Are you in the same line of thinking?
I wouldn't say no. And the reason why I don't answer, I'm in the same line of thinking. We will reevaluate at the end of the year. If inflation is persistent throughout September to December, we think rate hikes are a very real possibility in 2027. So a lot of it depends on some resolution to Iran, because that's the driver of the persistence. And that will determine, it's almost binary, will determine whether a hike is more likely than an ease. And that's dependent on the situation in the Iran war.
And that was Earl Davis, head of fixed income and money markets at BMO Global Asset Management. Coming up, Eli Lilly is using its obesity windfall to make a big move into vaccines. We'll have more after the break. Eli Lilly is buying 3 early-stage vaccine companies in deals worth up to $3.8 billion US. The move gives Lilly new shots targeting shingles, bacterial infections, and Epstein-Barr virus as it pushes into infectious diseases. Let's get more on this story with Jerry Smith from Bloomberg News. And Jerry, thanks very much for joining us.
Thanks for having me.
Okay, so what's driving Lilly towards the vaccines?
Well, Eli Lilly is flush with cash from the success of its diabetes shots and, perhaps more famously, its obesity drugs. And so now the company is using the windfall from all those sales to reinvest in other areas. So we saw a deal today where they're agreed to buy 3 vaccine makers. We've also seen them expand into make acquisitions in cancer and also in gene therapy. So this is a company that isn't resting on its laurels. I think, one thing we've seen in the past is pharmaceutical companies can have a very successful drug and get a little complacent and then fall behind. And what we're seeing now with Eli Lilly is this is a company that's already looking for its next act.
And I mean, is Lilly seeing a peak now for their obesity drugs, maybe?
I think this is a market that's expected to continue to expand. It's been growing up until now based on the success of weight loss shots. Now we're seeing a new frontier with weight loss pills, and Lilly has just entered that space as well as its competitor Novo Nordisk. So this is an area that I think a lot of investors expect is just going to keep getting bigger, even for Eli Lilly, which has already had a lot of success. But the company is realizing that it also needs to diversify its business. And so we're seeing that with really an astounding flurry of deals that this company has made so far this year.
And with these new acquisitions, are they established? Are they going head to head with established vaccine players, or is this a good opportunity for them?
Yeah, I mean, this is an area these companies they bought are developing vaccines in a bunch of different areas. Shingles is an area that there's competition in. Clearly, Lilly sees a competitive opportunity here. But you also have to realize this is a challenging space. We've seen under the leadership of Robert F. Kennedy Jr., the health secretary, vaccine makers have really struggled. There's been a lot of policy changes narrowing how many people can get vaccines. There's been changes made to the childhood vaccine schedule. Robert F. Kennedy Jr. is a notable vaccine critic. So this has been an area that's been challenging for other companies, notably Moderna. But Eli Lilly clearly sees an opportunity in getting into certain vaccines and certain respiratory diseases. And, this is an area that this company is, sees an opportunity in.
And almost out of time, but is this the end of the buying spree, or is there any buzz about more acquisitions?
We'll have to wait and see. I mean, this is a company that clearly has a very strong balance sheet. It's flush with cash from its obesity drugs. So I would be surprised if this is the end, but we'll have to wait and see.
All right, Jerry, thank you for that. Appreciate it. Bloomberg's Jerry Smith. Up next, insolvency volumes in Canada have risen to the highest level since 2009. We take a look at what that means for you right after the break. Prime Minister Mark Carney says a comprehensive trade deal would be a game changer for Canadian businesses and workers. His comments come during a three-day visit to Ottawa by Indian Commerce and Industry Minister Piyush Goyal. The two met to strengthen bilateral ties. Canada and India say they hope to conclude a trade and investment deal by the end of the year. American firm Northern Oil and Gas is acquiring a stake in Calgary-based Parallax Energy. The $350 million cash and stock deal between the two privately held companies will give Northern a 25% interest in light oil producing properties and 75,000 acres in the Duvernay Shale Basin in Alberta. Under the agreement, Parallax will continue to operate the assets owned by Northern. Shares of BP are under pressure today. The oil and gas company's board has removed its chair, Albert Manifold, effective immediately, citing serious concerns about governance oversight and conduct. Manifold only took over as chair in October. His removal comes as the company was supposed to be turning itself around after years of poor performance. BP says Ian Tyler will take over as chair on an interim basis. And a quick look at the markets. You can see the TSX down after yesterday's surge. It's off by about 0.66, still hovering around record territory. Yesterday was a record high for the TSX. South of the border, different story. And the S&P 500 up by 0.6%. And the NASDAQ, you can see up by more than a point, both sitting in and around record highs. A new Equifax Canada report says insolvency volumes in the country have risen to the highest level since 2009. Here to talk more about it is Rebecca Oakes, Vice President of Advanced Analytics at Equifax Canada. Rebecca, thank you very much for joining us.
Thank you for having me.
All right. 15 years since 2009. That was not a good year. What makes this so concerning right now, these numbers?
Well, I think there's a couple of things. So first of all, these are insolvency volumes. It's the highest since 2009. Now, since 2009, we have seen a lot of population growth within Canada. But if we look at the rate, so per capita level, it's actually the highest since 2019. Now, that's significant because in 2019, we were in a period of increasing financial difficulty and stress. And in fact, the only reason we seemed to come out of that really was actually the pandemic, where consumers pulled back on a lot of their credit usage. So it is a concern because obviously insolvencies are a great indicator of extreme financial stress across the Canadian ecosystem.
And did we see that with other prior times? Was there a pullback? Is that something we could be expecting right now? Or this time around? Not right now, but this time around?
Yeah, no, great question. So, I mean, like I said, 2019 really was a bit of a peak. And so we are experiencing a similar peak right now. The numbers are still rising. They've risen for the last couple of quarters. And so we do expect them to continue to rise probably, later into this year. Now, insolvency numbers do tend to be a little bit of a lag measure in the sense of, a consumer has to reach quite an extreme situation to become insolvent. So, I think what's really important is we look at what's also happening right now in Canada with some of the early stages of missed payments on credit. And, they are starting to stabilize a little bit. So there is some positive information as well as those insolvency numbers.
Have things changed on the help, I guess, for people who are approaching that decision of deciding if they go face insolvency or not? Have banks tried to work with them to try and avoid it, or things like that?
Yeah, absolutely. I think when a consumer is approaching that kind of financial stress levels, lenders are always willing to have conversations and try and help them through that situation. There are also lots and lots, of course, free organizations out there that can certainly support consumers through that kind of difficult period.
And just looking at the numbers, total consumer debt, 2.66 trillion, up 3.8%. That's concerning because, our population hasn't grown, and so that means people are building up more debt, aren't they?
Well, yes and no. So when we look at those numbers, a big chunk of that is actually mortgage debt. So around 3/4 of that headline number tends to be mortgages, and that is up year on year. And non-mortgage debt has risen as well. But what is a little bit of good news is that in Q1, we actually saw a pullback in terms of non-mortgage debt. That fell around $487 million at the end of the first quarter. Now, that's significant because seasonally, we wouldn't expect to see that amount of pullback or drop in non-mortgage balance. So what that tells us is consumers perhaps are being a little bit more prudent, that they may be pulling a little bit back in terms of some of their spending, some of their credit usage, which is good news on the credit side, potentially less good news if that continues for the business and small business side, because obviously, we need consumers to be spending to help the economy. So it is positive for the credit side, but maybe not so much for the wider economy.
Yeah, and there's the rub, isn't it? And with mortgages, how are they looking? We've seen mortgage rates surge over the last little while. They've flattened a little bit, but still, that must be putting pressure on.
Yeah, when we look at mortgages across Canada, average mortgage amounts, they have kind of dropped a little bit because some of those house prices have fallen. What is a concern, though, is still we are seeing missed payment levels on mortgages rising both from a volume standpoint and also from the overall balance of those mortgages across the country. Now, that is really concentrated in some of those hot housing markets of Ontario and British Columbia, where we did see mortgage levels really rising, particularly during the period of the pandemic. Post some of the renewals, when they're kind of coming off those low interest rates and going on to higher interest rates, that is unfortunately causing financial stress. Now, if you are in some of the other provinces like Quebec, Saskatchewan, actually we're seeing mortgage mispayment levels starting to drop now, but it is still a bit of a problem in those hot housing market areas.
And how much has the delinquency gone up? What's the rate at right now?
So when we look at the balances, it's around 32% year on year. In Ontario, that is 52%, and in BC, 36%. So it's those two provinces that are really pushing that up compared to 12 months ago.
And is that a concern? The fact it's up, it's jumped to 32%. Is that a big jump, or something that's manageable, or is it concerning?
I think when you look at it, overall, the percentage level is still quite small. So when we think about mortgages, they do tend to be the last type of credit product that a consumer will miss a payment on. So we're still talking quite low percentages, kind of 0.2%, 0.26% levels. So that side of it, it's small, but it is a wide indication of general financial stress within those regions in particular. Now, again, it's not just about the mortgages, of course. We have affordability challenges across Canada. And again, in some of those hot housing markets, that combination just makes it a little bit too much for many consumers to manage.
And which way is it? Do we have a trend on it at all, or is it still very uncertain, very volatile?
Yeah, so within Ontario and BC in particular, we are still seeing those numbers rising currently. When we think about the renewals and kind of the number of renewals that we had in 2025, there are still many that are renewing this year as well. So we do expect to see those missed payments on mortgages continuing through 2026, particularly in those regions. I think what's really important now is what's happening in terms of on the global stage right now. If you think about things like the inflation levels and kind of things like gas prices, that can have a serious impact in terms of not just homeowners, but also non-homeowners, particularly those maybe with lower incomes. When inflation takes hold, that can really tip the balance for a lot of consumers with those lower incomes. So I think what's going to be really important as well for the rest of the year is what happens to those gas prices and the impact that can have.
All right, we have to wrap it up there, but Rebecca, thank you very much for joining us.
Thank you so much.
Rebecca Oakes, Vice President of Advanced Analytics at Equifax Canada. Coming up, we're looking at why Canada's art market is expanding with our next guest. Stay with us. It is art auction season, and Canada is seeing a growing market for international artists like works from Vincent van Gogh and Auguste Renoir. And is it Van Gogh or Van Gogh?
Both are right.
Both are right.
Tends to
Okay.
be how you hear it, but we say Van Gogh.
All right, I should do the introduction now, and that's Canada's. Joining us to talk about Canada's art market is Rob Cowley, Canadian art specialist and president of Cowley Abbott. And thank you very much for joining us today with a Renoir.
With a Renoir right here beside us, which is being offered in our auctions tomorrow evening on Wednesday the 27th. So we're delighted to have this painting.
And where does this sit price-wise? What do you expect?
So the estimate on the painting is between $150,000 and $250,000. Comes to us from a private collection, a Canadian private collection. Delighted to have it. And again, one of the globe's best-known artists, of course, historically. So and a fine painting by him, a nice little painting by Renoir.
It is a beautiful painting, and it's sitting beside me. I'm not going to get too close to it. Bull in a China shop comes to mind. Let's talk a little bit about the art collection market in Canada. What is it like now? I mean, is that the norm, or is it across the spectrum?
Across the spectrum, and in fact, $150,000 to $250,000 right now is a great investment level for many collectors. We've had, sales even since COVID really have been excessive in Canada. The market's been very strong. Part of it's been driven by the quality and rarity of work coming to the market, both Canadian and international. We sold a private collection in 2022, 2023 that grossed over $36 million, including works by Emily Carr that exceeded $3 million, works by the Group of Seven that exceeded $2 million. So I mean, some of the strongest seasons and highest records we've ever witnessed have been in the past 5 years.
Now, have Canadians suddenly woken to that it is an investment? I mean, you obviously, do you buy? Let me ask that question first. Do you buy art because it's beautiful, or do you buy art because it's an investment?
I think you do both. I think certainly what you do is you work with professionals, you work with advisors, you educate yourself as well. Certainly, there absolutely is a place for investment in the art market, and we're seeing it more and more. But you also want to make sure that you're looking at work that has an interest to you, that you're educating yourself. As I said, you're reading, you're speaking to specialists, and you're buying in the right areas, so that even a work by a named artist, you're looking at works of rarity and quality. They're going to hold value over time while you enjoy them, and hopefully even increase.
And so what's changed then? The Canadians, I mean, you said the pandemic, but have they recognized it as an investment? And we're going to show, so here's some of the other pieces too. So you can answer my question and describe what we're looking at here too.
So what you found, honestly, Roger, in the past, certainly past 5 or 6 years, if we look at even the start of COVID, a lot of collectors and individuals had the time to spend or connecting or reconnecting to their passion for collecting, and also looking at the money markets and seeing that, that the right opportunities often rival those markets, sometimes exceed those markets. And the work we're looking at right here, this is a very rare etching by Vincent van Gogh. This was produced in the last couple of months of his life. It is the subject matter is Dr. Gaucher, who was actually caring for him and provided him with the printing materials. But that is one of the most sought prints in the market globally. It's in versions of it are in MoMA and other museums like the MFA in Boston around the world, and a great example of $150,000 to $250,000 as well, and a great opportunity for a collector. Yeah.
And then we have a couple others here. I'm just
here.
loving them. And what makes these so attractive to buyers? Is it the name?
It's the name, certainly, but also the quality, the rarity, the period. I mean, this Emily Carr canvas is featured on the front cover of our catalog. It's a 1936 painting called Wind. This is exactly this kind of subject matter that collectors are looking for. It's valued at $500,000 to $700,000. It hasn't been on the market in over 80 years. It was once considered for purchase by the National Gallery of Canada while Carr was alive, and coming to the market for the first time. And with the strength of the market and such strong prices and opportunities, it continues to bring quality and rarity to the market, and that's what drives our market.
Now, there are obviously individual buyers who can afford these, and other people are looking going, this is out of my price range. Is there ways to buy art as a group? Or compete, like, are there like an ETF for art, something like that?
There is. More and more you're finding that there are consortiums now and even funds that do invest in artwork in a group setting. In Canada, that's happening more and more as well. And that also provides a real signifier to us in terms of the opportunity for collection and for investment. And you're finding that has only increased over time. The New York sales that just wrapped up, I think we saw $2.5 billion in sales, which was double last year. And again, driven by quality, driven by rarity, rarity driven by opportunity for collectors. But you're finding all kinds of opportunities for all types of collectors right now.
And who gets to hold on to the piece of art if you're a consortium?
That is up for discussion, certainly. Oh, I'll talk about, there's the last work, actually. So this is Lauren Harris from the Group of Seven.
I love Group of Seven.
I mean, paintings like this is a Lake Superior scene by the artist. Works like this have exceeded $1 million in recent seasons, and this painting could certainly do that. A fantastic example by the artist. And one of those names, he was the first artist to sell for $1 million, $2 million, and over $10 million at auction in Canada. This is valued at $500,000 to $700,000, which I think is a great opportunity for a collector.
And what artists are hot or styles?
It's a wide range. In Canada, over the last 20 years, what you've witnessed is a widening of the market. So that certainly historical artists like the Group of Seven and Emily Carr have continued to be very hot. But also you have abstract artists like Jean-Paul Riopel and Marcel Ferrand, a female artist as well. And then contemporary artists as well, even artists that are living now. Works by Kim Dorland, Kent Monkman as well. Mm-hmm. So you find it's a very wide market. There's a lot of opportunity, not only in the major live auctions twice a year, but even online auctions where collectors can begin to collect even at below the $10,000 level. So it isn't just talking about six figures. There's an opportunity for collectors at most levels right now.
And from an investment perspective, what kind of returns is? I mean, it's like anything.
Like anything.
Past returns do not guarantee future.
Exactly. I mean, we saw in New York this week, we saw some works that doubled in value over 5 or 6 years, quite honestly. And often it's quality and rarity that drives that opportunity. If we're looking at artists like Lauren Harris, when I started in the business 25 years ago, the record for a Lauren Harris painting was about $2 million, 2.4. Now it's over 10. So I mean, there's opportunities. Again, why you educate yourself, why you speak to specialists as well, who can help to guide you in those areas.
All right, and what do you like?
I like a bit of everything. I love this painting. This painting beside us, I absolutely love. I love the Emily Carr. I absolutely love the Lauren Harris as well. We're very, very fortunate. We get to spend time with all types of different works every 6 months.
And do you miss them when they go?
I really do. I was just saying before we started, you take it for granted a bit because you're working so hard and talking about them all the time, and then the auction takes place, tomorrow night, and they're all gone in the days to pass.
And then and there was the 2 seasons, right? So February. Yep. Spring and fall
Spring and fall. We are now collecting for our fall sale on November 25th. And in between that, lots of online sales at cowleyabbott.ca.
All right, Rob, thank you very much for joining us. Thanks for leaving this for us.
Okay.
Beautiful gift.
Enjoy it.
I appreciate it. He's not leaving it, trust me. All right, Rob Cowley, art specialist and president of Cowley Abbott, with some beautiful pieces of art here. Coming up next, there seems to be a growing gap between weak consumer sentiment and strong expectations for stock market gains. We'll have more after the break. Consumer sentiment surveys are near record lows, while investor expectations for higher stock prices remain elevated, pointing to a disconnect between households and markets. We got more on what's causing that disconnect from John Zechner, founder of J. Zechner Associates.
It's quite the dichotomy because, I mean, the story used to be is the economy would drive the stock market because the economy drives earnings drive stock prices. And to some degree, you talked about that in the last segment, the way earnings have been strong. But it's just interesting right now when I look at U of Michigan and the Conference Board surveys came out last week again in the most recent. And in both cases, they have moved to all-time lows, like not recent lows, we're talking about all-time lows going back 7 years. This is below, COVID. This is below the financial crisis. And I thought that is, desperately bad consumer confidence. And then on the other side, you've got the expectations of the highest, supposed to 60% expect stock prices to be higher in the next year. The holdings of stocks in the U.S., by most of the measures I've seen, over 70% of portfolios right now, which is, again, the highest level ever. So people have this believer. So how do you sort of rectify this dichotomy, or how does it resolve itself over a period of time?
I was going to say, how long can this continue before they split apart entirely?
Yeah, or which one breaks down? I think you have to look a little bit more at that economic data. Why is it so strong and what's driving it versus that consumer confidence level? And I think a lot of it, first of all, the AI spend. As we've talked about before, the 4 hyperscalers alone are, $700 billion. Then, it's basically $1 trillion of tailwinds from the capital spending on AI, which is that explains 40% of the growth in the U.S. economy last year. That exceeds what you saw in the bubble in 2000, where it didn't even get get to 30%. So that is a massive, massive tailwind. On top of that, you've got, governments everywhere are spending like drunken sailors. I mean, Canada's doing it and upping it because we have to on a global trade basis.
I don't know if you heard our numbers. We've got the highest debt. We're at $3.4 trillion across the provinces.
Yeah, no, you're right. I was thinking
Ottawa.
the same thing, Roger. And what's interesting too is I think you mentioned the same thing. I think that gets on a combined basis to 85% of GDP. The U.S., which are usually a 10-to-1 ratio on, they are at 36 trillion, and they're over 100% of GDP. So they're even worse on that basis. But all that spending is again an economic tailwind. The big beautiful bill in the U.S. So you got these factors that I don't know that's sustainable for long periods of time. And the third one that's driving the economy is the wealth effect. And again, it's that's tilted more to the wealthier end of the population. They're the ones because their stock markets going higher, the value of their investments are going higher, and they're running down their savings rate, and that is sustained into spending. So you got three factors that are good tailwinds for the economy. They're sort of concentrated in sort of the higher wealth areas, not across the whole economy, that are maybe not sustainable. On the other side, you've got the average consumer, middle class, lower income. They're way more impacted by higher food prices, higher gasoline prices, and that's where you're getting these really, really negative sentiment numbers. So, how it resolves itself, they will move back together at some point, because ultimately, like I say, it's the economy that drives the stock market. But for now, you've got, a very explainable, but, an odd type of dichotomy between, the economic data and the, consumer confidence data.
Have we seen 2008, dare I say, the Depression? Have we seen points where, like the market crash of 29? Have we seen points like this where it was so, the divergence was so clear?
No, not really, Roger, because like I say, the consumer confidence data, the Michigan survey is an all-time low, and that was, I think they started that after the Second World War, so you don't get the Depression in there, but you certainly get 2008, but I remember 2008 markets very well, and consumer confidence and investor confidence were both at absolute low levels, and I'm not the type who get excited about the stock market. I'm a glass half empty more type of person all the time, Roger. That's the last time I remember being very, very bullish. Was back at that point, but because of that, the economic data was low, interest rates were falling, the economy was going to pick up at the same time, investor sentiment was very low. I like that combination. Right now, you got the opposite mix. It concerns me a little. Maybe not as much sustainability on this economic growth because of those tailwinds that may not last. On the other side, consumer confidence and the economic data is not that stirring.
And what are you doing with this?
Well, you can't change your whole philosophy based on anything like this. I'm still, we're invested as we typically are. We're in the middle of the range. I'm just looking at more defensive positionings. I look at things that when I look at a stock more, you want to know what the upside is in the growth. I also want to know what's my protection on the downside. Why I look at areas like software lately, Roger. I know they've become like a defensive play. You notice on the down days in the market, they're the ones who act a little better because the valuations are already so low. So our portfolio is structured right now that at least I can participate on the up days or in line with the market. So we're sort of there, but we pick up a lot more performance on the down days, that's for sure.
That was John Zechner, founder of J. Zechner Associates. Toronto businesses are bracing for a wave of FIFA World Cup tourists as the city scrambles to finish last-minute preparations. CTV's Heather Wright has more.
Extra TVs are being hung up at Fox & John's, a restaurant and bar in Toronto's Liberty Village.
We're adding TVs basically anywhere we could fit them.
Bar manager Samantha Basteo says World Cup preparations began 6 months ago and include the hiring of additional staff and a new streamlined menu to help serve the packed crowd expected here throughout the tournament.
It's going to be such a fun time here just in the city as a whole, but it comes with a lot of nervousness and we kind of don't know fully what to expect. So we're kind of going into it super excited, positive spirits, kind of ready for anything though.
Liberty Village is used to hosting big crowds. The neighborhood is the unofficial gathering spot for fans of Toronto FC. But the crowds expected during the World Cup will likely eclipse anything this area has seen before. For the roughly 10,000 people who live here, the tournament brings excitement and some trepidation.
It's definitely going to be busy, but I think it'll be fun. It'll be a lot of good vibes.
With 45,000 fans expected to pack Toronto Stadium for each match, in addition to the fan festivals located nearby, the foot traffic through this part of town will be a big boost for businesses.
It's going to be interesting, I guess. There's going to be crowds of people. There's a lot of hype behind it.
Kevin McDougall owns Merci Mon Ami with his wife, a restaurant and catering business. It has survived the economic crisis of 2008 and the COVID pandemic. He says the economic climate right now is just as tough, and the World Cup will be a big help.
So the margins are tighter than they ever were. So something like this definitely will help increase volume, which increase, revenue. So your margins are still tighter, but you're getting more revenue.
So the World Cup kicks off in less than 3 weeks here in Toronto, with the city expecting more than 300,000 visitors over the course of the tournament. Heather Wright, CTV News, Toronto.
All right, let's take a quick look at how the markets are performing on Bay and Wall Street. You can see the TSX is off by about 0.6% right now. There's like three indices in the green, but materials dragging everything down. Same with consumer staples. But one we want to talk about, MDA Space. We can bring that up, and it's booming because of SpaceX right now, and it has been on a nice rocket ride. If you look at it, it's up another 4.5% for today. And a lot of other space sector stocks have been climbing on all this news that SpaceX is going to IPO. So good to see it going. Market calls coming up next. Ryan Modesto, CEO and Portfolio Manager, Guide to Capital Management, his focus North American stocks. That's next. Thanks for watching Morning Markets. I'm Roger Peterson. We'll see you back here tomorrow.